So in today's episode, we got 3 tips for purchase loan agents. So if you're out there doing purchase loans and you're trying to get your business mustered up, this is something that's going to serve value to you. I'm going to serve you with 3 tips to help you pick up your purchase game in this current market. Welcome back to Sales Remastered. If you are new here, my name is Daniel, and I post content on sales hacks that you can apply in any field, covering insights from psychology, wordplay, and even mindset hacking to help you reach the top of your field that much faster. If that is what you're looking for, make sure to subscribe and hit the bell to get notified for any new content. Now let's get back to the video. Are you a purchase LO? Are you solely focused on purchase loan transactions? Meaning that you're out there hunting for referral partnerships, you're out there hunting for potential buyers in this current market. It's a good time. It's definitely better than it was a year ago. But the truth of the matter is that we're faced with an increased rate market. And so the same house that they could have bought, a year ago, probably cost them about $1,000 to possibly even $2,000 less than if they were to buy it today with today's current rate. And so what does that mean for you? Does that mean that you throw in the towel? Does that mean that you wave your white flag and give up? No, it doesn't. I'm going to share with you 3 tips to help you pick up your game in this current market as a purchase loan agent. All right, tip number 1. Today is the time to revisit your past pre-approvals. What does that mean? So I'm sure as a purchase loan agent, you have a ton of pre-approvals that you did, but you may not have closed a transaction. And that could be for 1 of 2 reasons. Either number 1 is they probably were swayed by their realtor to go with their preferred lender. And so they probably bought a home, but the agent probably, referred them to a lender that gave them kickback. And that's very common. That was very common, and it still continue to be very common. Another reason could very well be that they just stopped because they got overbid and they went into bidding wars. And so they felt uncomfortable to give an amount that was higher than what they felt comfortable with, right? What we have within our loan origination system is records. We have data. And so if you go back into every single application that you pulled within the last year or 2, you're going to have pre-approval letters. And one way to do this is you go into your LOS system and you incorporate the column that shows the FICO score, right? And the reason for that is because you pulled credit on that individual. Why that is of value is because it shows you who you potentially prepared a pre-approval letter for. And so why is this important? Is because that person, whether they bought the house or not, either number 1, you could check in to see if they're open to a refinance. Because if they finance on a government loan, like a VA or FHA, that's who I would stick closely to. Any pre-approval letters that you qualified within the last year to 2 years under a government loan like FHA or VA is something that you want to pay close attention to. And you want to revisit. You just want to check in. And whether they went with another lender for financing, that's okay. Check your ego at the door. Don't worry about that. Don't be mad, right? Just check in. Let them know that you have somewhat of a history with them because your company provided them a pre-approval. And why that's important is because if they use government financing like VA or FHA, likely they have enough equity to where they may be able to use some of that to their advantage. And so if you think about, pre-approvals that you did about a year ago, 2 years ago, those property values have increased about 10 to 15%. And so if they did a 10% down payment, they may have some equity to pull some cash out. In the very least, you may have a property or a client that has enough equity to remove the mortgage insurance and get into a conventional loan. That's why it's of value. Second is if you go through your pre-approvals, and let's say that you go through, people that actually purchase loans with you. So they secured financing and they bought their property under VA or FHA. They could very well have enough equity now to where they can improve their term. And most likely it's going to be through way of debt consolidation. And so of course with VA, you have that net tangible benefit where if you're north of 89.99%, you have to make sure that you're providing NTB. NTB is net tangible benefit. That means that you're increasing their residual cash flow, you're lowering their rate, you're helping them pay off their term faster, whatever it is, right? So again, why I say 89.99% is because if you're at 89.99% loan to value, then you don't need to worry about the LTV. But if you're at 90 plus, you need to worry about the NTB. What does that mean? So if you are increasing their rate, or you're increasing, you may not necessarily be improving their residual income because you're just giving them cash out. Well, then keeping at 89.99% LTV is going to protect you from that NTB filter. And so if you're at 90% or 95% or 100%, but you're able to pay off debt that helps increase the veteran's residual income, meaning that you're giving them some sort of increased cash flow, then you're good, right? But that's going to mainly pertain to those who are paying off debt. So you got to pay close mind to that. You got to pay close attention to that. So if you had a FHA borrower who bought their property and they only put 5% down or 10% down, because at the end of the day, what we have to think about is those pre-approvals that we did over the last year or two. If they were in a government loan, they had to come in with some money, right? Because at the end of the day, they were really competing with people who were paying cash. And so you may not have that many, but those that you got pre-approved, if you followed back up with them, the likelihood of them still being in a government loan or not even having a property that they actually purchased is very high, right? And so if we follow back up with them and we find out that they took a break from shopping, now's a good time to rekindle that flame, right? Now's the time to revisit them. And so we can give them an updated approval. We can share with them the excitement that they should have, because if they didn't buy a property yet, they're actually headed into a climate where property values are going to be more easier to buy. And so the reason for that is because the inventory has increased. And so if they didn't buy a property, that's fine. Now it's just going to be less competition. Now, granted, of course, the rates are going to be up. The qualifications are going to be a little bit more strict, right? With a higher rate, it means less buying power, but still, at least you're able to kind of keep them within your net. You're able to stay connected with them. And if they decided not to pay or they kept getting outbid, they're still in need of a property. And if they're interested in buying a property right now, it's going to be better off for them because they're not overpaying, or they're not at a risk of paying more than the property actually appraises for. Thus, they have more of a down payment. And so if they were actually making bids, but they're getting outbid and they had to give more of a down payment, keep in mind that the loan amount was based on the actual appraised value. And so, if they offered $10,000, $20,000, $30,000 higher than the offer price, it all still comes down to the actual appraised value. And so if they needed to put 3.5% down on the appraised value of $100,000, but they had a bidding war and they, finally got accepted approval of 125, the loan amount and the loan details is actually secured on $100,000. So they need to come up with the 3.5 on 100,000, also on top of the $25,000 gap. And so if they're willing to do that, that means that they already refocused or repurposed some of their assets and they're able to do that. And that's fine, but maybe they weren't at that stage at the time that you gave them the pre-approval. And this is why it's very important to make sure that you reconnect. Now, the second tip is it is time to revisit your past purchase clients on government loans. So any loans that you completed under FHA or VA loans, it is the perfect time to revisit them because, again, property values have increased. And because of the cost of living increasing, you are likely to find someone who may need some cash out on their equity. And the reason for that is whenever you buy a property, you always got to keep in mind that the immediate thought is we have to have a party just to celebrate the purchase of a new home. And when that happens, you got to really think that people are doing certain projects on their property to make it ready for that particular party, the celebration, right? So when someone buys a new home, typically what happens is they usually do certain repairs. Often those repairs are anything from new paint to new appliances to new furniture. And these things cost money. So when you bought a house and you put, $30,000, $40,000 down, the likelihood of you financing those certain costs or fees is high. And so if you think about, when you buy a property from renting a home and this is your first home, you want to make sure that the house looks nice, right? Because you're going to more than likely throw a party to celebrate your new purchase. And when that happens, these are debts that people accrue, and that's on top of the mortgage. And so if you were to keep track of those people that you helped purchase, or you at least bought a home, the likelihood of them having new debts where you can now help them with the refinance is very high, so that you can give them some cash out to pay off those debts. So do not sleep on your past purchase clients who finance on government loans. And the last tip number 3, is you need to start doing some research. When you have a buyer who's interested in a property, and this is something that you can share with your referral partners, is you need to start doing some research on the seller, because the likelihood of that seller potentially being on a loan that homeowner or that buyer can ultimately assume is going to be very advantageous. What that means is that if a seller has, let's say, an FHA loan, or they have a VA loan, these are loans that are assumable. And so even if it has mortgage insurance, or even if it's a VA loan, these particular loans are unique because they're assumable. If they're a USDA loan, those things are assumable as well. Now, why is that important? Is because if a seller has an assumable loan, they have a rate that was captured more than likely probably within the last 2 years. So within 2022. And so if they had an assumable loan, let's say, for example, on an FHA loan that was at 3 to 3.5%, or probably even lower, now that seller doesn't, or the buyer does not need to qualify for 7%. They actually are able to assume the loan. Now, granted, there's some caveats that they may have to come in with some cash or a down payment, but still what they have in their advantage is that they can assume the lower rate, which then allows them to have more buying power. Of course, you have to coordinate with the seller, make sure that they contact their servicer so that they understand the conditions that are needed for the buyer to assume the loan. But still, I think that's a gem that a lot of people are sleeping on. So make sure that you do a little bit of research. You make sure that you incorporate that in the conversations that you're having with potential referral partners. Let them know that you do your homework. Let them know that you'll do the recon to make sure that if the seller has an assumable loan, that you'll be the first to know so that you could bring that to the buyer's attention. Why your referral partners will like that is because that realtor does not get paid unless that particular buyer actually closes on the transaction. So you want to be able to kind of bring that to the attention of all parties involved. And so if in the event, let's say someone who bought their house in 2022, within that window, and for whatever reason they decide to sell, whether they can't afford it anymore or they decide just to move because a lot of people are relocating. If you found that home that was on an assumable loan at a very low interest rate, that gives you the advantage to make sure that the buyer has more buying power because they're at a lower interest rate, but they also have the ability to secure interest rate that's no longer around. So think about that, because if the seller was to give their loan up and they had a 3%, that's far better than if the buyer had to qualify at 7%. So they have more buying power, they have a little bit more cash, they may be able to get creative enough to where they could bring in a second and enable them to acquire the property still with a minimal down payment. These are things that you want to make sure that you're keeping in your arsenal, because as a purchase agent, I think now is the time to shine, but you got to get very creative, because I'm sure over the last couple of years, it's been a brutal crash against people that were buying homes all cash. And so you may have been servicing or assisting a lot of potential buyers, but they probably didn't collect or connect or complete their close because they're going up against, overseas companies or investors that were paying cash, and they went into bidding wars. And even if they did actually close on a finance, if it was a government loan, you have the ability to now refinance, but you also have the ability to keep that book of business. And that's what's going to keep you afloat. So make sure you pay attention to this. Let me know which of these 3 tips you find useful by commenting below. And don't forget to hit the like button. Don't forget to subscribe if this is your first time catching some content on Sales Remastered, and share it with your team. I'll catch you on the next one. Bye. Now it's your time to hit the thumbs up if this video helped you. I love engaging with you in the comment section below. Lastly, please share this video with someone else that can benefit from this topic. Thanks for subscribing. Look out for the notification for my next video, and I'll see you there.